Today, folks, I am obviously not selling my SCHD position, but I've been seeing these large debates, and I presume it's from content creation and boredom, but videos like this have been surfacing so lately on my For You page here, with superior dividend ETF investing to beat SCHD in 2024. And the comments are hilarious because I think people are catching on to this churning of content to continually get views. As you introduce a new ETF every week, which one do you actually invest your money in? And then there's a slew of comments and a lot of debate going on, and I think it's very fruitful and an educational piece. As I've currently got, again, about $50,000 sitting in SCHD. SCHD's had a nice comeback, but incomparable to the S&P and many other stocks, I think this is a very personable decision. As I want to compare SCHD to DGRO and kind of just ask yourself, what is the better ETF for your personal or circumstance? Because I personally love SCHD for the diversity that it gives me across the sector of stocks and ETFs that I already own. Taking that into consideration in the charts of these ETFs, is I want to compare directly DGRO, which is one a lot of people have been raving about, especially in these videos, against SCHD and of course the S&P 500. But what I want you to take into consideration here first and foremost is that depending on what time scale you're looking at, the performance of these are dramatically different, which is really fascinating depending on what management's done with these ETFs. And we'll break down the components in a moment, because obviously with tech selling off on recent earnings, we can see that, SCHD and DGRO are actually outperforming because they tend to be less tech heavy ETFs. Over 5 days, can't really trust the 5 days. Let's zoom out on a 6-month chart here. We can see with the performance of tech, for the first 3 months of the 6-month chart, everything performing pretty much in line up till recently when tech really started to take off and it kind of started deviating away from these traditional ETFs here, which, by the way, DGRO is in yellow, SCHD is in the dark blue, and the Vanguard VOO is in the brighter blue. As we zoom out a little farther, let's take it out on a 5-year chart here. We can see that basically the S&P should be trailing through most of the best performance because tech tends to overperform if you give it enough time. But we can see there's times where SCHD actually outperformed the S&P 500, and it's really interesting because DGRO never really seemed to actually pace out the S&P, which I found very interesting. And we're going to kind of do a bit more comparisons here. Now, to zoom out any farther won't do any justice here, because again, once you go into like 5 and these 10-year charts, they're not taking into consideration the dividends. And considering these ETFs came public at dramatically different times, these charts aren't actually reliable because you'd have to pace them over for when they came public against the S&P 500. But let's talk about SCHD, why I like it, why I'm not selling it, and then we're going to compare it to DGRO here, which is again a favorite for growth, because one of them is more growth oriented on the dividend side, and the other one is more, I think, for dividends today, but actually has offered exceptional dividend growth over time. Because again, the management fees at 0.06% for SCHD and about 0.08 for DGRO, I don't think is something to get overly worried about. A couple 0.0 percentage points different aren't going to impact your wallet in any significant way. But the holdings is what I find most fascinating, because when we take a look at SCHD, you'll see that most of the top holdings are in industrials, financials, and healthcare. Only 12% is sitting in information and technology, and honestly, the upper weighted companies are mostly actually in some of these tech companies and healthcare, which I like a lot, because we can see the vast majority of the top 10 holdings that make up about 40% of the entirety of the ETF have like Broadcom and Merck & Company and AbbVie, and we've talked about this with Home Depot and Verizon. I really like the top list of company here. There's even Coca-Cola and Chevron. Just for the diversity is just nice, but people kind of get into they kind of get a little nitpicky, because if I bring up all the holdings here and we scroll down, there's a lot of companies that I don't like in here. Obviously, we got Pepsi, which is amazing. Lockheed Martin, another great company, but people are pointing to the fact that like 3M's in here. I don't like Altria Group, but these are very insignificant. 2% is Altria Group, 1.5% is in 3M. Ford Motors, I don't agree with, but that's 1.3%. I like Kimberly-Clark. There's a lot of other companies I could kind of detest in here, but again, it's for the diversity of the portfolio, because as somebody that has the vast majority of their money in the S&P 500 and there's somebody that's buying tech stocks individually, I don't want to be buying ETFs that are overweighting these tech companies. And we'll do some dividend comparables in a second, but again, just taking a look at DGRO in comparison here, we scroll down and you take a look first and foremost at the exposure rating. 18% is financials, which is heavily weighted, in my opinion, compared to SCHD here again. And I just want to do this side by side just to give you that clerical view, because basically financials only make up 16% of SCHD here, and it seems a little bit more diverse between those top 3 sectors, whereas 18% financials, 17% information, and 17% healthcare. So a bit more concentrated. And again, I'm not going to be buying this to get an increased exposure to information. Now, if I was in a retirement phase, maybe, I could look at this, but if I'm in retirement, I'm probably going to be looking for higher yields than this. But they got Microsoft and JP Morgan and Broadcom, ExxonMobil, AbbVie, Johnson & Johnson, Apple, Chevron, Procter & Gamble, but these are much lower weighted as well. We can see the top holdings only make up 3%, and these are in the top 10 here go down to 2%. So you're not seeing the same concentrated weightings here, which I think is something that is leading to some of that lack of performance. As we go down again, Merck & Company, you'll see a lot of overlay between SCHD and DGRO here. But again, I think it's much more diversified with much less concentrated weightings. In my opinion, I mean, there's 424 stocks in this. I think there's so many pages in here. I mean, there's so many stocks, and they just get so diluted when you get to the bottom. If we take down the 42nd page, some of these make up 0.01% of the entirety of the ETF, which at that point is just so dilutive it doesn't make sense. So this is probably another reason that I think SHD has had a bit better performance, because even from the dividend front, the 5-year growth rate on DGRO here has only been about 10.18%, and it's been much more volatile for some reason. You think with that amount of holdings, you'd see a bit more stability in the ETF, but maybe from waiting, changing the holdings around or who knows what, there's been a lot of volatility over time with the dividend payout, whereas SCHD over 5 years has offered a 13% growth rate. And, the dividend payout has been a little bit more rocky in recent years, but, more consistent with an up and to the right trajectory, right? From 25 cents a decade ago to today, where we're getting 74 cents. So just pretty much, a good tripling of the dividend, whereas DGRO has gone from about 17 cents to about 37 cents, which hasn't seen the same performance for what should be a primarily dividend growth ETF. So I don't know if that's just the lack of time in the market, maybe management doing a lot of shifting, but these are things you have to take into consideration. And just again, taking my portfolio into consideration here, you have to be careful when you're buying ETFs, because people think they're just buying this broad exposure of performance, but really if you're buying a multitude of ETFs, you're likely, reweighting the same companies over and over again, and you probably don't really know how they overlap. And there's softwares out there that can actually break those ETFs down if you were owning multiple ones and show you what the overlap is. But personally, I like SCHD because I feel it upper weights some of the lower half of the S&P 500, because I am severely weighting tech companies for that excelled growth. And I find this gives me a much better balance for growth and income, because we can see that I'm getting about a 2.2% yield across the portfolio today, but I'm still looking to buy some more diversified holdings, including in the Canadian markets, but with tech companies that I'm starting to buy back individually. I really just like SCHD. I think it's just one of those stocks that fits much better than me just buying, the S&P and then just buying DGRO or something, where I'm just really weighting the same stocks, but perhaps over diversifying at the same time. Because again, diversity is going to take you away from performance. So I'd rather just pick what I think are the cream of the crop and focus on not over diversifying and getting my portfolio to a place of simplicity. But again, I think it's so personable, right? Do you think you're going to get better dividend compounded growth out of DGRO and you have a long time horizon and you're just focused on dividend growth? Then by all means, buy it. For me personally, I like the best of both worlds, and I think SHD has a little bit longer of a track record and proven performance. And even though I don't agree with all the holdings, I still trust management to be following a system that's worked. And we'll see how it kind of does moving forward. And you can always subscribe to my channel to see that performance on my path to financial independence, perhaps one day retire early. And if you're on that path as well, you can subscribe and we'll do this together. But on that note, stay cool, stay awesome. And as always, I look forward to catching you in the next one.